I want to welcome everyone to what I call the RSI Edge. Those of you studying with us, both here and at home on tape, have already completed the original levels. You come into class with an impression the first day when we first met, either through tape or lecture, that the RSI was a simple little overbought, oversold indicator. I think you left the original course understanding that it's a pretty dynamic indicator. We have rules, we have guidelines for trend. I try and share rules and guidelines for you as a trader also with mindset. It's probably, trading has been referred to as probably the hardest way to an easy living. Because when you're right, it's just unbelievable how much money you can make. When you're wrong, you have to learn to get out quick, cut the bleeding. Applying yourself to the rules of trading, of control, both emotionally and mentally, of being focused and staying focused on what your goal is in trading. This is why the first section is called Trading versus Making Money, the Big Difference. Everybody has great aspirations when they first come in and great expectations. And you get slapped around with a few bad trades. If you haven't learned, you better have some pretty deep pockets or else you won't be very long as a trader. But if you apply rules, discipline, focus, and patience, I've said it before, the 3 keys to success: a trading program, a methodology that's solid, has shown itself and proved itself both in uptrends and downtrends. Number 2, the patience to wait for the signals. And number 3, the discipline to follow the rules of the trading program. We can all say, well, it looks a little different now and I don't have a buy signal, but I think I'm ready to buy it anyway because I heard it's good. It can be good. It can look great for the first day, but if you're violating rules, that's, to me, more important to follow your rules than it is to make money and to trade. Because by following your rules, you will make money. You should. If your program is solid, you see the signal, you execute the trade, you should make money. The one thing I enjoyed about teaching the basic course was to open people's eyes up to something that they thought was just a simple little momentum oscillator. This simple little momentum oscillator, after teaching basic, intermediate, advanced, now edge, doing CNBC and making commentary and presentations at conferences all over the world based on one indicator. George Lane is a friend of mine who teaches stochastics. Years ago, we were both teaching at a CompuTrack conference in Vegas. And I asked George, I said, I'd like to ask you a question. He said, sure, everybody else has been asking questions all weekend. Why not you? I said, mine's simple. If you had it to do all over again, what would you do? His response was, you're doing it. You're doing just like I did. You took one indicator, you learned its personality, the little nuances that it has, the volatility, whatever, and then started focusing in on 3, 4, or 5 markets. There's thousands of stocks out there. But if you focus in on markets that you know you like trading each market can be quantitative in terms of a trend model, but you know yourself that there are certain markets that you like to trade. Everybody has their favorite markets. And George and I, the other thing I asked him, I said, how would you change things if you could? He said, I wouldn't change a thing. He said, like you, George, he said, like you took the RSI, I took stochastics and learned it. He said, and then I focused in on 5 to 10 markets and learned the personality of those markets and how the personality of those markets reflected itself in the movement of the stochastics. That's basically what I did with the RSI. The rules, the guidelines for trend analysis, trend change, pattern recognition. I've worked with the RSI since 1978, and it's never changed in 25 years, almost 25 years. People's opinions and perspectives change. Markets are markets. The session here, the first session, as I said, is to get your head on straight. And trading versus making money, I've said to people before, you will understand more about markets and yourself by trading than anything else you do. You will see yourself go through periods of elation and joy when you put a trade on and it works, and desperation and despair when it moves against you. If you look at the trade, if you look at a trading decision objectively as opposed to subjectively, this is why we use technical analysis to understand where a market is in its movement, which way it's moving. If you understand that no matter what you do in a trading decision, you have no effect on that market, but that market has an effect on you because you have a perception of what you perceive to be down the road. Two traders, it's a zero-sum society or a game, a buyer and a seller. One expects prices to be higher tomorrow, the other expects them to be lower. This is why God made vanilla and chocolate ice cream. We have choice. You can choose when it comes to trading also to participate or not participate. There are basically 4 decisions that you can make. You can buy, you can sell. You can hold the position you have, either from the long side or the short side. Or you can offset that position. You also have another choice, and I've talked about it before in lectures. A decision not to trade is a trading decision. We have a chart in the first section we'll get to on batting averages. But most people feel if they're not in the market, they're not making money. When you run into bear markets and most of the issues are going down, you can almost make more money by saving yourself money and staying out of the trade. But most people that I've run across, unless they have a position on it, they're talking about their next buy or their next sell, they're not happy. If you want to see the successful traders, look at the ones that pretty much have a good outlook on life, a belief, and an understanding of themselves. Through the courses, I can teach methodology. I can't teach you discipline. I can teach you what to look for. I cannot teach you the patience that you will need so that you don't jump the gun and just go in half-cocked into a market. But once you start to understand yourself and what trading is really all about, is when you will have an appreciation, even more so, for who you are and what you do. Everybody says they want to work for themselves. Trading is the goal of a lot of people. And there are people that I know have gone through the courses who have gone on to manage multi-million-dollar funds. But the thing that made them successful was having the discipline to follow the rules and the guidelines. What we've gone through in the basic courses, the originals, my original course, were the basic guidelines. What we're going to go through in the edge are take what we know to a higher level. The 3 keys, as I said before, the 3 keys to success, the methodology, the patience, and the discipline. If you focus on your patience and your discipline, the methodology takes care of itself. The first thing I always ask a group when I'm teaching Why are we here? Because we want to learn. We want to be better. You want to practice. And it's amazing how the more you practice, the luckier you will get. I play golf quite a bit, not as much as I'd like to. But one day I was presented with a shot in a bunker, and when you have a $10 bet on that one hole and pop it out of the bunker onto the green and roll it down within 2 inches to the cup, one of the guys said, "Boy, you're pretty lucky." The other guys said, "You ought to see him over here hitting him out of that sand trap every night for an hour. It doesn't matter how hot it is. He's sweating." But the thing was, the more I practiced, when I went into the sand trap, I was not afraid or concerned or uptight of coming out of it because I had practiced so much. I was presented with the chance. One of the last things we'll cover in the last part of the course is how much luck plays in your trading. But my definition of luck is when preparation meets opportunity. If you study your rules, your guidelines, and have your discipline, when the opportunity presents itself, you'll recognize it as an opportunity, not as chaos. As an analyst, you're presented with people calling and asking, "Oh, what do you think of this market? What do you think of that market?" And I always tell people, to be a trader, you have to be half crazy. To be an analyst, you have to be totally gone. Because we as analysts have to make sense out of chaos. We have to see opportunity out of confusion. In the Chinese language, the symbol in their writing for luck, opportunity, confusion, and chaos are very similar. And it's quite interesting to see people look at a market, see the opportunity, but don't have the discipline to focus. They just say, "Oh, everybody's excited about it." Well, if everybody wants it, it's probably close to a top, and we'll see how we can find those things. We will also find a lot about ourselves in trading, how we handle profits, how we handle losses. And losses are part of the game. You have to take them. For these people that say, "Well, I made my last 100 trades, I made 90 out of 95 or 95 out of 99 profitable." Well, I just walk away. The ones that tell you almost nothing and don't get excited about markets, they may say, "We sell a good opportunity developing." That means they're already under consideration, a particular market they're considering to trade. There's lots of markets to trade if you let the market show you what it wants to do and be objective and allow it to tell you. Joe Granville calls it the music of the market. Listen to the music of the market. You've been doing RSI charts long enough now to where after taking the course and finding range rules, moving averages, and patterns, you know what to look for. You're already ahead of 95% of the people that use the RSI. Coming into the edge level, going through the basic courses, you understand that bearish divergence is actually bullish. And bullish divergence is actually bearish. But you should see the look on people's eyes, on their faces, when I give a lecture and the first time they've heard me speak and I say, "Well, bullish divergence is bearish." And they say, "That can't be right because everybody told me it's bullish." These are the same people that once they see bearish divergence, sell short, looking for a reversal, and can't understand why it keeps moving against them. Most of them don't have a focus and a plan of attack. The same as a baseball team or a football team or a hockey team. Before they take the ice, the coach has put a game plan together and told them, "You've practiced, you work hard. Now the time has come to where you just subconsciously allow it to happen. I coach myself Little League, and I tell the kids, feel the game, become part of the game. Have a little, almost like psychic energy in your body. If it's going to be hit here, I think it might be hit to my right, so maybe I'll move over to the right side and the ball will be hit there. Try and become a part of the game. Because once you learn how to play the game, that's one level. You see what in your mind should happen in the market. Market moves manifest themselves quicker in your mind than they do in reality. And this is why we have to exercise patience. I catch myself many times saying, oh, it's going to bottom here and then it's going to take up there and then down. I wait for that bottom first, but try and anticipate what should it do based on the patterns I'm seeing. So that when it does start to unfold that way, you know you're in tune with the markets, that you're a part of the game. When you are involved in any game, that game has rules. When you break the rules, you are penalized. Trading is one, when you break the rules, it hits you right in the wallet. Because trading is real once you put it on. You can paper trade all day long and make $1 million a month. But when you have to make that decision, if the little voice goes over and says, well, we better wait, it's a little too aggressive, or I can't afford that much on the trade. This is why you're always brokerage firms say only risk capital. Well, it's real. It's true. If you can't afford the risk on the trade, don't make the trade. But if you do your homework and you look for positions in the direction of what you see as the trend, you can look at where you think it's going, where you think you're wrong, which takes you into risk, reward, and probability. Most people look at risk and reward. Well, I think I can make $1,500 a contract on this futures contract, or I can buy this stock and make $10. Then they look at the reward. I can maybe make $1,500 and I'll risk $500. Good ratio to start with, 3-to-1. But most of them don't consider the probability. You now at this level have in your toolbox, your trading toolbox, guidelines for trend, identification patterns for trend change, being able to forecast where prices are going. You're assessing the probability of the trade in relation to the risk and reward. Most people will listen to someone else and not really do their own work. To those, I say, it's your money. You worked hard for it. If you're going to invest it wisely. Why should you follow somebody else? Especially when I have a broker call me and say, well, Mr. Cardwell, and I know it's a broker. And they say, we'd like to talk to you, but I'm calling today because evidently you requested information on our company or our services. 99 times out of 100, I didn't. They're cold calling, trying to get some business. I was a broker once. I was with a small brokerage firm. And where they were more interested in bringing business in that we could trade, I was more interested in trying to understand something in the market that I could use. And that's when I had discovered the RSI. So we know why we're here. I knew where I was when I was with the brokerage firm. I wanted to learn and become an analyst/trader, but I wanted to understand why. Little kids, why daddy? Why daddy? Why is the sky blue, daddy? They're always asking questions. Best traders I know always ask questions. And believe me, I asked a lot when I first got started. And that's one of the reasons I taught the course. Trading is hard enough on your own. But if you can get with people who have been around for a while, who have experience, who understand to a degree markets, it's a big help. And it was to me when I got started. So when I've taught my classes and lectures and now the Edge, it was my way of giving back because there were people there when I started. But that one question of know why you are trading. Are you trading for excitement? Are you trading for you want to be able to make a little extra money on the side? Or are you trading because you worked hard for your money and you're going to put your money to work for you? I'm not saying it's easy, but what I've gone over in the last couple of years through the courses and sharing with people is to give them the opportunity to look at markets independently, do their own research and analysis, and be able to make their own decisions. At the RSI Edge level, we're going to take everything that we did in the previous courses and take it to a level beyond playing in the game. Now we're into be part of the game, feel the game around you, almost raising your higher consciousness where you're operating on a subconscious level. When you can take rules and guidelines for both trading and emotional control and mindset and operate in a subconscious state, you will see markets in a different light. Jamie many times says to me, you're just like out of it now. And I said, yeah, it was a great day. I wasn't on the phone. I had no emails, and I looked at charts all day long. Because I got so far into it that I said, hold on to this string, and if I get out too far, pull me back a little bit. But when you get to the point and you know you've studied your charts and you know that feeling that you have, athletes refer to it as being in the zone, where you can feel it around you. And yet you feel removed from everything around you at the same time. It doesn't matter if I'm sitting in the office, in the living room, at a coffee shop. I can become almost entranced and in a zone. We're just looking at the charts and say, well, this is getting ready to do this. So you make a little note. I need to take more time to spend with this chart or that chart. And you'll look at other charts and it's not saying anything to you. At that point, you leave that market, turn the next page, go to the next chart. If you try and force the issue, if you try and make a trade out of something that's not there, you're asking for trouble, and I'm sure many of you experienced it, and you knew it going in. Well, it really wasn't that great a trade. I was just making a trade to make a trade. You should have a damn reason you make a trade. And a reason of a place where you can place a stop and you can forget about it. Because once you buy, put your sell stop underneath, or you sell it, put your buy stop above it, there is nothing that you're going to do to affect the outcome of that trade. Many times I'd seen new traders, met one in New Orleans who was going to day trade. Never day traded before, but he's going to day trade and make 4 or 5 trades a day and have most of his trades done by 12 o'clock, make his $300 and go. Kept telling him, study the markets. Are you sure you want to do that? It's not as easy as it looks. But when I was saying with feeling it, you know yourself at this level after going through study, preparation, you can recognize opportunities. That's when your work begins. You make a note to yourself, okay, I've got a market I really want to look at. And then you do further study. You figure out where the price targets are from the positives, where the price targets are from the negatives. What are your sell points? What are your buy points? Where's your resistance? Where's support? What do you need to see it do quickly in the first hour, if you're trading hourlies or 15-minute charts? What should the market show you if you are indeed in tune with it and it's moving in the direction that you see? Many people get ideas from newspaper, from talking to friends. When I was a broker, there was a fellow we called Fast Eddie. I've referred to him before. Fast Eddie would come in at 8:30 in the morning, ready to buy. Well, he'd run into a friend of his, a client of the firm, who was ready to sell. Then Eddie changed his mind, and when the market opened and it went down initially, he said, well, maybe my friend's right. And he reversed his position and went short, and then that was about the time the market turned and went back up. I kind of miss Fast Eddie because he was a great little reverse position for us. If we saw him buying, we'd be selling. But Eddie had no trade plan. And I would say probably 50 to 70% of the traders out there are trading without trade plans. They may have rules that they've written down. They'll show them to you. But they violate most of those rules when they make their trades. You have rules, they're meant to be followed. You want to break them, you're going to pay. I mentioned before about your health, mentally, emotionally. You need to keep yourself focused, need to keep yourself well. And I know right now I'm trying to teach I don't have a sore throat, but I was, got sick. An athlete keeps himself in his body in shape. A trader has to keep his mental state together, his physical state, and his emotional state. There's a big difference between market psychology and trader psychology. As I said initially, the markets do not even know that you exist. In the first section, we call trading versus making money. Our first chart says the basic bar structure. If you look at the basic bar structure, the top chart has a solid line, which is your high for the day, your low for the day. Close. It doesn't matter if it's 1 day, 1 hour, or even a 5-minute chart. It'll go up and down between the high and low as people's opinions change throughout the day. But at the top of that, where it says basic market structure, first point is price. Price, most people recognize because of the fact that's where the market is quoted, the last price. That's where the buyers and sellers have expressed their opinion, and some say it's overpriced, some say it's underpriced. This is why we have price movement. People move in the direction of what they expect to see as far as the future expectation of price. But in this market structure, you basically have points 1 through 6. Price, everybody recognizes. Momentum can be measured in a number of different ways. RSI is just one. But even a moving average of one period, where if you drew a line on the close or with a bar chart connected to close. In the courses we learned, I've shown examples before of the basic line on close. And if you look at that line, you will see whether it's moving up or moving down. You won't see the high and low during the day. Most indicators, though, are based on closing price. Momentum is one I like to use. Simple momentum sometimes, today's close minus the close of 5 days ago, 10 days ago, or 20 days ago, depending on the time frame you're looking at. But all it's showing is how much price has changed. But these 6 points here are all components that we have to understand and realize are part of the market itself. Point 3 is time. Or one other point about momentum. A lot of people like to use price action and look if volume is confirming it. Is price moving up with volume? Is price moving up and volume decreasing, saying that fewer people are committed to that side? Or in the opposite case, if price is falling, momentum's going up, everybody's trying to get out the door at the same time. The time sentiment, many people measure time cycles, and we've got some cycle charts that we'll go over quickly, just to refresh your memory and also to realize if there's a cycle low due next week, the aggressive traders will be buying this week. The conservative traders will buy next week. The ultra conservative will wait to see whether the price cycle made a low and then it turned up. 4, sentiment. The bulls and bears. Jesse Livermore said, it's not the bull side or the bear side, but the right side. That's what we try and stay on, depending on our time frame. Everybody's time frame and personality are different. Some that are trading 5 minutes, some are trading hours, some are trading day, and some are trading mutual funds weekly. Depending on your perspective on time, you should always, and I'll mention this in different sections, should always focus on one time frame longer than you're actively trading in. If you're trading hourly, keep a daily chart. If you're trading in 15-minute world, use an hourly chart because the short term will be affected by what the long-term picture is doing. 5, risk and reward. A lot of people start off with no program at all, no idea of risk, reward, and probability. And they say, well, I'll risk $1 to make $1. You should go to Vegas with that. The lotteries that everybody plays, have you ever looked at the amount or the odds of winning one? The big game here in Georgia, you have to pick 5 numbers out of a series of 50 and then one matching number out of a series, I believe it's 35. To get and hit the number that comes up, your odds have been estimated at 54.5 million to 1. You have a better chance of being struck by lightning or run over by a train. But in the trading world, you should consider trades not only with risk and reward, and the ones that you found using RSI so far are a heck of a lot better than 2 to 1, 3 to 1. And sometimes it can get scary. I've seen trades that when I set the positive reversal target, I figured we're going to see maybe $1,500 in profit on the trade. And it blew my mind when the risk was only like a quarter of a point in bonds, $250 risk to make $1,500. When you started getting into 6, 7, and 8 to 1 probability, or 6, 7, 8 to 1 reward to risk ratios, you do get excited. That's where you have to really execute your patience and your discipline, not to jump the gun. Because the last thing you'd want to have happen is to put the trade on, get all excited, miscalculate the stop, put it too close, and get stopped out. But if you're able to identify reward and risk ratios of 3, 4, 5 to 1, and the market starts to move in your direction, number one, you've probably got a pretty good trade on. Number 2, you've done your homework. And number 3, you've positioned yourself in the direction of what should be the emerging trend. With the positives and negatives, we're able to identify trend change and price forecast and set price support levels or resistance levels for stops. We have some things in the RSI Edge that we will show you how to quickly assess whether it's turned. How to identify with what I like to call the stairways to heaven. I had one person ask me, was I some rock group fan on their song Stairway to Heaven? When you can build a staircase, we will get into it with the bar charts. It's a very exciting point, and it's a very simple point on the bar chart where if you look at the close, say yesterday's close, if tomorrow's activity is all above yesterday's close, then the bias is to the upside. If it closes higher on the day, it shows a gain for the day also. If all of activity tomorrow is below last night's close, look for a down move. And then when it closes below yesterday's close, it further confirms it. A simple bar chart with no RSI or anything else. If you look at a bar chart and just note where that close is and the activity the following day, draw a horizontal support line at that closing price level. Well, you know about positives. If you could see a positive and the next day the market opens higher and closes up and never took out the previous close, and the next day maybe trades back down a little bit but doesn't take out that close price as a low, that close price is serving as support. Your RSI value is based on close, and it works well, just as well in the 5-minute world as it does in the 15-minute world as it does on a weekly chart and a monthly chart. But being able to look at a bar chart, most people, given a bar chart, I could give the same bar chart to 10 people. They would all draw lines on it based on their personal biases, their opinion of themselves that day. Were they in a good mood or a bad mood? If you're in a good mood, you're going to buy uptrend, you're going to draw uptrend lines. If you're in a not so good mood, you may be looking at resistance lines and looking to sell it because you're mad at the world and it's too high anyway. And it may not even be halfway up the chart, but you're ready to sell it because you're ticked off because you tried to buy it before and got stopped out. Whatever the reason, this is why I say your mindset is very important to you. It's as important as your manuals are. Probability, number 6. We assess probability based on range rules, positives, negatives, direction of moving averages. But most people look at 0.5 and reward and risk ratio and don't really consider the probability till after they've lost. Then they say, well, I didn't really have a good chance. I was just making a trade and it looked like a good reward to risk ratio. The bottom part of the same chart, market price activity and momentum sentiment index. This is something I did a long time ago, and it's been in every manual and a lot of the short-term lectures I do of an hour or 2 hours. If you look along that line and see where it's in the middle, it says 0, balance of buying and selling. This can be for the day. It could be a daily close. It could be an intraday price or an hourly close. As the prices move up to +1, it has an upside bias. Bulls are starting to feel they're in control. Bears are starting to feel a little bit of heat. As it moves up to number 2, +2 on the upside of the scale, momentum and sentiment are probably starting to get a little high. Everybody's getting a little hot on the floor. If you're long, you feel great. If you're short, you feel it's moving against you. If you're taking a position, you have to know where it's going and where it is along this line. But this is something just to understand that prices will move back and forth. Perspective changes. People's opinions change based on whether or not you're in the trade or not in the trade. You see it up at +2 and you've been wanting to be a buyer. Are you going to jump in? Or are you going to wait and see if it pulls back? If you're already long, are you taking a profit? The reverse on the downside, when it starts to fall, if you've bought at about the 0 level there and it moves a little bit against you, you say, okay, well, I'm going to give the market some room. And it gets down to the -2 level and you start wondering how much room you're going to give it. Or my stop might get hit, or maybe I should change my stop. Or maybe I'll just take it off at market and cancel the stop. If you make your decision to enter a market based on sound technical input, you've placed your order, you've gotten your fill, you place 2 orders actually when you place a trade. First, you give your broker your buy, and you give me your stop loss, or you give me your sell and give me your buy stop. I always say place your sell stop first. Mental stops don't work because they can be changed. If you want to buy a market, say, here's where I want to buy it. Here's my stop. What do you have to do after that? Nothing. And it's this urge to want to do more. And I know I'm using daily charts, but I'm going to look at the hourlies and maybe I can add another one here. And all this is going through your mind. It should be in your trading plan. At the end of the day, what you're going to trade the next day. Because during this price activity, and as I said, the markets go up, markets go down. When are you more clearly focused? Being an RSI student, you're more clearly focused after you've seen the closing price that day. Because it's giving you a pattern. It's telling you what it did for the day. And it's showing you where the RSI is on that chart that day. The markets are now closed. You're able to see that pattern or that price close and RSI value in relation to everything else. And it's true of all your studies. Now you've got more input. Now you do your analysis and make your decisions after the market has closed. You're not sitting there watching CNBC trying to figure out your next trading signal with the ticker going across and say, oh, there's Microsoft. It's down $1. I better buy more. If you haven't bought it and you're not in it, don't worry about it till the next day. Get the input you need. I've seen many good traders shorten up their perspective. They were fabulous fabulous daily traders, even hourly traders, that when they shortened it to that time frame of less than an hour, they started making different decisions. But I've also seen the other way. I've seen great short-term traders who have the mindset and have the discipline to buy on a 5-minute chart or sell on a 5-minute chart or work on the 15-minute charts. But when it's spread out to a longer and they tried to look on dailies, they couldn't handle it. Everybody is different. And once you understand, again, where you fit in, what feels right to you, it'll help you in your trading. But that chart there, like I said, I've used it before, and it's been very helpful. If you look at it once in a while, just on the idea of market movement and how it can affect what you're seeing, what you're thinking. The next one is that high, low, close bar chart, single day. Doesn't matter if it's a day, doesn't matter if it's a week, an hour, whatever. In this case, we see where the market opened, the high for the low for the day, or high for the day, low for the day, and the close for the day. We see a net gain from the open to the close. Most people say, well, the market was up that day. Looking at that chart, most people say, well, that's an up close. Yes, it closed up at the end of the day in relation to where it opened. But unless you know the previous day, this is just a moment in time. It's another data input. But by itself, it's just a moment in time to where yesterday's close could have been higher than this, and this makes it a down day. Yesterday's close could have been lower than this close on this chart, which would make it an up day. But you don't know anything other than the fact you know what the high was for that period, what the low was for that period, where it opened, and where it closed. But being a moment in time, it's a data input. But a lot of people made and lost money in that one period. That's one thing you can be sure of for it. There are buyers, there are sellers. And it happens all day long. Every period that's on your chart is a different input as to the perception of traders and what they see. But always remember, and I learned this a long time ago, where a market opens and where it closes shows basically the net gain for that period. But it's a moment in time. You have to put all these periods together to get a pattern. You can't get a positive reversal or a negative reversal or bullish divergence or anything off of one period of input. But what you can realize is how small. When you talk about you feel small when you're at the ocean, think of one grain of sand in relation to all the others. If you picked up just one grain of sand, you wouldn't see the beach. You'd see one grain of sand. When you look at a bar chart, one period, you see that moment in time. But it doesn't mean anything unless you relate it to what has happened before. And is it forming an up day or a down day? And for that one period, it doesn't show you much, but it does show you what the open to the close was for that period. Your next chart is a chart of Microsoft, a bar chart, just a daily. All would be right with the world if we could buy in September and sell in early January, if markets were that easy. Now think of that one bar chart, one line of one period of trading. This chart is a daily chart and has a combination of those lines. Prices gradually moved up. After the September 11 incident, all the markets were hit hard. But I'm not looking at the chart in terms of from the September 11 attack as much as it made a bottom and it went up for a while. Then it made a high in early January, then it went down for a while. You had movement. We cannot trade if we don't have movement. Markets go up, markets go down, markets go sideways. What we need is movement. If your money is sitting in a trade and the trade is going nowhere, it's costing you money. So we want to try and buy low, sell high, which you've learned with range rules for trend and everything. But the reason I focus on these charts at the beginning today is understand that one moment in time chart or that one period of time, how it's almost nothing compared to what took place on this chart. There are people that made money and people that lost money. Your next one, a bond chart, shows basically a market that went up, a market that sold off, tried to make a bottom and come back up. But you had movement. It was going in a direction. Options traders, when you're buying options and you expect to see a market go up, you're buying the calls. That's great as long as it goes up and continues to go up before that option expires. The option trader has to be right on price, direction, time, all of it. When you look at charts and you see movement and you see the market moving one way or the other, you see trend. And the importance of trend is where you make your big money. Markets that are chopping around, you're going to get chaos, you're going to get confusion, you're going to get frustrated unless you have the mental toughness. And this is what the edge is about, the RSI edge. I want you to be mentally tougher than you've ever been before. I can teach a methodology, as I said before, but I cannot teach patience or discipline. I also cannot teach control in a mindset. When I say mindset, I'm not trying to say we're trying to get into your mind as much as for you to understand why you trade, why we're here. Why do we even attempt markets if they say, that it's a crapshoot? It's not a crapshoot if you can identify reward, risk, and probability. but you will have to understand yourself more than you understand markets. I spend more of my time now, probably in the last few years, on understanding psychology, both of the market and, more importantly, myself. If you want to understand yourself, understand the fact that we only use about 5% of our brain. If we actually put the whole brain to work, we'd do more. You stimulate your brain activity, keeping it focused. Understand the fact that we are not perfect. We will make mistakes. But when we make those mistakes, not to stay down on ourselves and allow it to keep us from what we can achieve. Every day is a new day. Every day in a market is a new day. I think trading itself is probably the most fascinating business and endeavor you will ever get into. You've learned a lot on your own from trading. You've learned a lot in the courses. But every day is a new challenge. As an analyst, as a money manager, as a trader, I'm only as good as my last recommendation to most people, except for the students of the courses, because they've learned. To a brokerage house, you're a number. Your account is a number. Yes, they're great. They're a great help for this or for that, and they're always there to support you. But when it comes down to it, you're the one that has to make the trading decisions. Do I buy? Do I sell? Do I do nothing? And as I said before, a decision not to trade is a trading decision. Holding a position is a decision. You've looked at your charts, you say, I want to hold it for another day. The trend is still up. If you're short, I want to hold it for another day. I think tomorrow we're going to hit that negative reversal target. You've seen using positives and negatives that you achieve a target. You get a positive reversal and the market goes up. First of all, you've got a target of where it should go to. We're going to discuss failures too, what they mean when it fails to achieve that target. But let's look at it first as if it achieves a target. In the case of the bond chart, in September, October, when we started up, there were targets up there that we were looking to achieve. We saw the market get up to the level we had targeted, and then sell off and reverse. If it's a downtrend and you're still seeing the market move in the downtrend direction, you're setting negative reversal targets. As long as you continue to hit those targets from your positives on the upside or your negative reversals targets on the downside, the trend is in your favor. You may only have a one contract position in that trade. You may have bought one bond down there at the bottom. And this is where it becomes interesting. I like to mention this to people. You think you're in competition with markets. You say, well, I figured them out. I know where it's going. You think you may be in competition with other traders. You're trying to out-trade your friend who says he's a better trader than you are. Then you get into a little wager or a little bet. Analysts bet too, believe me. I've talked to many and said, I think it's going here. But when I make a bet, if it's in baseball, on my Yankees, or whether it's in a market, I've tried to look at the probability. And I try and remove myself from the emotion side of it and look at numbers. If I think a market's going to go up and you're seeing positives and you've seen that positive reversal target achieved and surpassed, then you're able to stay with the trend longer. If you see that as you approach that positive reversal target, the market is not achieving it on close, and the market's ready to sell off. It doesn't have the muscle to get up to that target. Then you might want to tighten your stops up, and we'll get into this weekend. But the point I put up on these charts are great to look at after and look back and say, how did I miss that? How did I miss that bottom in September? Or how did I miss that top in October? What didn't I do? Where was my head? What was I thinking? It was all right there. This is why I say the focus that you have in your trading is dependent on how much it's not that you want to shut out the rest of the world, but you want to be able to look at markets objectively, do your analysis, align your probability, your risk, your reward, and then your job is done. Because you're not going to change the outcome of the market. The market doesn't even know you exist. And as far as being in competition with somebody else, I could be in competition with another trader. Well, that's a personal thing. Now what have I done? I'm no longer objective looking at my charts. Now I've brought in somebody else that I'm trying to have a little debate with, or going to outtrade, or he's going to outtrade me. You are not in competition with other people. You are not in competition with the market, because the market is a figment of your imagination. You're reading a line going up and down across the chart. You're reading your positives and your negatives, seeing where your moving averages are. You're in the game. This is the game you're playing. But the market doesn't know you exist. Other traders don't really care whether you make money or not. Who are you in competition with? Yourself. And when you learn to understand that you are in competition with yourself with respect to following your rules, then you look at the markets a little different. When you can look at markets objectively, you can read your indicators objectively. You don't have to be running 50 million indicators. Elliott Wave's great, candlesticks, whatever else you want to use in complement with your RSI work. When I first started sharing the RSI knowledge that I had developed with traders and everything, I said it's a great independent tool. It's the best assistant analyst you will have. It can be used with candlesticks, stochastics, moving averages. I've shown in the classes how I've look at the RSI patterns, look where the MACD is. Just a funny side note, I had a fellow who attended a workshop taught by someone else. And at the end of the first day, he was so confused that he had taken his original basic RSI manual with him. Because he was going to learn something new. He wanted to see if it worked with RSI. Well, somebody come up to him and asked him, "Did you have problems in class today?" He said, "Yeah, I was really confused." He said, "You figure it out?" He said, "Yeah." He said, "I looked in here. It was in an 80-40 range. It was in an uptrend. Or it was in a 60-20 range, and it was a downtrend." The range rules alone will keep you out of trouble. They will also help you to stay with a position longer. The chart there on the bonds in September and October, that bottom, when it came off the bottom and started to shift up and the moving averages turned up and the RSI turned up, it kept you in the direction of what was a trend. When we had the sell-off, we saw that we were getting real high at that time. But if you have the focus and can keep distance and understand that it doesn't matter what market you trade, it doesn't matter actually even what time frame. I know 5-minute traders, some of the best traders I've ever seen is 5-minute traders. Others I know trade only dailies and weeklies. Understand yourself. Do you have the temperament to be a 5-minute trader? Do you want to be tied to your machine? Do you want to have to sit in front of that machine all day long and live and die with every tick? Or do you want to be able to turn around, identify a trend, and put a position on? I think what you've learned so far in RSI probably lengthened most people's time frames. Some it's shortened, and then they realized they didn't have the temperament for the volatility that you say in a market during, say, a 15-minute period or even a 5-minute period. But the importance of movement is what brings us all into trading. That we have to see movement, or else we're not going to be able to make money. A market goes sideways, we can't make hardly anything. A market's in a strong uptrend, you can ride, you can see additional positives along the way. When it gets overextended, take profits on partial, a third, a half your position. You start off with 2 contracts and it goes up and it hits the targets, and you see with RSI, SMA 3, everything else, it's very overextended. And we're going to get into a section that I really haven't discussed before about acceleration factors with RSI. That when you kick in that acceleration factor, just tighten your stop up. Don't take half your position off. Let it run. But you see movement. We need the movement to make the money or to make the profits. But profits should not be your first objective. Your first objective should be to follow your rules. Follow your rules, your discipline. Let the market show you what it's going to do, and have the discipline, the patience, as we said, to wait for the signal. I personally have recommended trades that I got a little excited about, got in a day or two early, got stopped out, only to see the thing take off. We all make mistakes. If we don't learn from the mistakes, we're bound to make them again. I have a friend who says he makes a lot of mistakes. He just tries to make new ones all the time. And stops, it brings us to another point too, as far as stops. Once you have identified your entry point, once you've identified your targets with your positives or your negatives, you've identified your stop loss, you should not be changing it that much until the chart shows you should change it. And when we get into using, as I said, draw that line on close. If you have a positive reversal and the bar chart that day said, all right, here's the close bar, the hash mark where it closed, extend that line all the way across your chart horizontally. That's your support level.